Welcome to Info Caretaker. Today we're diving into a question that's stirring up Wall Street, Silicon Valley, and maybe even your own investment group chats. Can AI predict the stock market? We've all seen the headlines. ChatGPT writing trading strategies, hedge funds pouring billions into machine learning, and everyday investors wondering if they can automate their way to financial freedom. It almost sounds too good to be true. An algorithm that watches every tick, reads every headline, and predicts where to put your money before the market even moves. But what's the reality? Is AI truly the future of investing, or just a new kind of hype? Let's break it down and uncover the truth the headlines aren't telling you. To understand whether AI can predict the market, we have to look at what it's really doing right now. AI isn't just some futuristic sci-fi concept anymore. It's already everywhere in the world of finance. From high-frequency trading algorithms that buy and sell stocks in fractions of a second, to natural language processing tools that scan news articles and earnings calls for subtle market-moving cues, AI is working behind the scenes, 24/7. Take BlackRock, for example, the world's largest asset manager. They've been using AI for years to analyze risk and optimize their portfolios. JP Morgan uses machine learning to flag unusual trading activity. Even retail trading platforms are experimenting with AI to give users personalized stock picks. And it goes deeper. Companies like Kensho, Dataminer, and Numerai are building advanced predictive models that try to read between the lines of market data, not just looking at numbers, but interpreting patterns, sentiment, and correlations that would take humans weeks to untangle. But here's the key thing most people don't realize. AI doesn't see the future. It sees patterns from the past, and it bets on them continuing. That's both its strength and its biggest weakness. You might be thinking, well, if AI can predict the weather, why not the stock market? And that's a good question. But here's the difference. The weather follows physical laws. It's chaotic, but ultimately governed by thermodynamics and fluid mechanics. With enough data, you can model it, at least in the short term. The stock market, it's governed by human behavior, emotions, hype, fear, greed, panic, and humans are unpredictable. The stock market reacts to perception, not just data. A great earnings report might send a stock down if expectations were too high. A terrible headline might get ignored if investors think it's already priced in. AI can recognize patterns, but when the pattern is people, things get messy. Even the best models can get blindsided by a tweet, a war, a banking collapse, or a surprise government policy. Just ask the quants who were caught off guard during the 2008 financial crisis, or even during the 2020 pandemic crash. AI is great at probabilities, but the market isn't about being right 100% of the time. It's about managing risk, emotion, and timing. So, does that mean AI can't help? Not quite. In fact, it's already changing the way some investors think and operate. While AI might not have a crystal ball, it does have superpowers, and investors who know how to use them are already gaining an edge. Let's look at how AI is really being used in trading right now. One major area? Sentiment analysis. AI models can scan thousands of tweets, Reddit threads, news articles, and press releases in milliseconds, detecting shifts in public opinion before they explode. It's how hedge funds picked up on GameStop's Reddit-fueled rally before it went mainstream. AI doesn't get distracted. It doesn't sleep. It just absorbs everything and gives you signals humans would miss. Another big win for AI is pattern recognition. It can study decades of market history, technical indicators, volume spikes, and correlations that most analysts wouldn't even think to consider, and then test thousands of strategies in simulation. This is called backtesting, and it allows traders to validate ideas at lightning speed. But it's not just hedge funds and big institutions. Some retail investors are now using platforms like Trade Ideas, Turing Trader, and even ChatGPT-powered bots to assist in spotting trade setups or automating basic strategies. It's not full-on autopilot investing, but it's a powerful co-pilot. Still, AI isn't magic. For example, it can overfit to past data, meaning it learns patterns that aren't real, and then fails when real-world conditions shift. It also can't factor in things like insider moves, private negotiations, or sudden geopolitical shifts. And then there's the black box problem. Even expert developers often can't fully explain why an AI made a specific trading decision. That's risky, especially when real money is on the line. Even some hedge funds have pulled back from AI strategies that seemed promising in backtests, but fell apart in live markets. The lesson? AI is a tool, a powerful one, but it still needs a human in the loop. Here's where things get a little more dangerous. As AI becomes more accessible, more people are trying to use it to get rich fast, plugging models into stock tickers, scraping Reddit, and asking ChatGPT for the next Tesla. But most of these people will lose money. Why? Because they treat AI like a cheat code. They assume that just having access to an algorithm means easy wins. But markets are adversarial. If a pattern becomes too obvious, or too many traders are using the same AI model, the edge disappears, the market adapts, and the advantage vanishes. Even worse, many retail traders are downloading pre-trained models they don't understand, or buying AI signals from shady providers with no accountability. It's like trusting a robot to drive your car without checking if it knows the difference between the gas and the brake. The truth is, even the best AI can't save you from bad risk management, unrealistic expectations, or plain old market noise. And if you chase hype without doing your homework, AI won't make you rich. It'll just make your losses faster. So, where does this all lead? We're heading into a world where AI won't replace investors, but it will change what investing looks like forever. Just like how GPS didn't replace drivers, AI is becoming a tool that makes better decisions faster for those who know how to use it. Already, major financial institutions are pouring billions into AI infrastructure. BlackRock, JP Morgan, Goldman Sachs. They're all racing to develop next-gen algorithms that can analyze risks, detect fraud, and yes, even optimize trades in real time. What's interesting is that the future may not be about one super powerful model predicting everything. Instead, it could be about swarms of smaller AIs, each with specialized skills. One for reading the news, one for parsing charts, risk, and one for handling strategy. All talking to each other, working in sync. It's also possible we'll see AI-assisted investing for everyone, not just the rich. Imagine asking your voice assistant, "What should I invest in this month based on my risk tolerance and market trends?" and getting a portfolio suggestion backed by machine learning. But here's where we need to pause, because with all of this advancement comes a very real risk: over-reliance. If too many people depend on AI systems to make trades, and if those systems all follow similar logic, we could end up with a highly fragile financial ecosystem. Think flash crashes, AI feedback loops, and sudden market breakdowns caused not by human fear or greed, but by code misfiring at scale. This is why regulators are starting to pay attention. Because if AI ever becomes the driver of the market instead of just a tool in the passenger seat, we're in uncharted territory. So can AI predict the stock market? Not exactly. It can process faster, analyze deeper, and uncover patterns we'd never spot. But it still lacks something fundamental: judgment. It doesn't understand irrational behavior, unexpected news, or the nuance of human emotion, all of which shape how markets move. AI doesn't panic during a war. It doesn't feel hope during a bull run. And it doesn't recognize the fear in a CEO's voice during an earnings call. Markets are ultimately made up of people, and as long as humans remain unpredictable, the stock market will too. So don't fall for the hype. Don't expect a robot to make you rich overnight. But do stay informed. Learn how these tools work. Understand their limits and their power. Because the future of investing isn't man or machine. It's man and machine, together. Thanks for watching Info Caretaker. If you found this video eye-opening, hit that like button. Subscribe for more deep dives on AI and the future. Let us know in the comments. Do you think AI will ever truly beat the market?